So we try this question that we have here. This is the first thing we start with before we can start looking at other things. So we have a Brabo Limited. I hope my screen is visible. It says what? Abrabo Limited is a fruit juice manufacturing company that is located at Dadieso, Aba, in the Ashanti region of Ghana for the year ended 31st December 2023, with the following information in its income statement. So it has a foreign exchange loss of 730,000 Ghana cedis. And then they've given us some notes, right? That even within that 730,000, we have a realized exchange loss being 430,000 and an unrealized exchange loss being what, 300,000. And they are saying that the detailed examination of the realized exchange loss revealed that 40% were incurred in respect of transaction with resident companies, and that 20% of the remaining were in respect of assets bought in 2022 year of assessment. And they say ratio applies to the unrealized exchange loss. So we should calculate the total amount of foreign exchange loss to allow us a deduction for tax purposes and explain the tax implication. So what did we learn about foreign exchange losses the last time? Which ones are allowable deductions? Yes. Which foreign currency loss is an allowable deduction? What did we learn the last time? Let's go back. The whole thing is that with the passing of the Amendment Act, we learned that only realized forex losses incurred in the production of income during the relevant period are allowed for tax purposes, right? And then unrealized foreign losses are not eligible for deduction. Foreign exchange losses arising from transactions between two resident persons are also excluded from the deduction. And then we learned that what? Forex losses of a capital nature must be capitalized, right? It must become cost of the asset, whether it is realized or unrealized in nature, right? That's what we learned. So with this simple thing that I've done, looking at this example, can we tell how much must be allowed? How much will be our allowable forex loss? Yes, based on what we just read. We just read. We know that the realized forex loss, how much will be realized?
That's the 430.
Okay. No, the whole 430 will not be realized because look, it says what? Detailed examination revealed that 40% were incurred in respect of what? Transaction with resident companies. You get it? That means how much will be realized? How much should we recognize? Because we learned that transaction between resident companies should not be realized, right? So that means 60% of what? The 430,000 should be realized as an allowable deduction. And that gives us how much?
258,000.
That means 258,000 should be recognized, right? This is the only thing that we can allow, right? But let's come to capital allowance expenditure. How much can go into capital allowance expenditure? The what? The one that relates to capital items. Do you remember? So how much of this related to capital items? It told us that what? 20% of the remaining were in respect of what? Assets that were bought in 2022, right? So it means that when we talk about the realized portion, no, it wouldn't be 60%. Do you know why?
It should be 40.
Telling us that, so the split is like this. They are telling us that the realized, okay, 20% goes to went into capital assets production, right? Or acquisition. 40% went into resident transactions, right? That means the remaining 40 went into the goods, which is the actual realized transaction that we are. I hope that makes sense. So it means if 20% went into the purchase of capital assets, 40% went into resident transactions. It means that what? 40% is the actual realized one that came from goods, right? So that means you have to take 40% of the 430,000, and that gives us a. I hope that's understood by everyone.
Yes.
That gives us what?
172.
172,000. Okay. Then what about
Yes.
the capital allowance expenditure? They realized they said 20% went into the purchase of the asset, right? So 20% of the 430,000.
Yes.
And then the unrealized one was how much? That was also 20% of the 300,000 also.
100. Yes.
Okay, so this will be how much?
86.
86,000. And this will be how much?
60,000.
So this is 146,000, which will be added to the pool, right? So if the asset is in pool 2, let's say it was a vehicle, we just add to pool 2. Do you get it? The remainder, if we subtract the whole thing, is the non-allowable. The allowable expense portion will be what? Non-allowable deduction. The non-allowable deduction part to be the whole 730,000 also, minus what? Minus 170,000, minus what? 146,000. No, it should just be minus 172, right? Because this part is not allowable. It goes into capital allowance computation. So what becomes the answer? The portion that is not allowable.
5,580,000.
55. That is 55.
5,580,000.
Okay, 558,000. Thank you. Please, is it understood by everyone?
Michelle, don't fall.
Let's look at trading stock. Trading stock is simply the deduction for cost of sales, right? The deduction for cost of sales. Now, usually a lot of people think this is so easy. Yes, of course, it's easy, right? But the whole thing is that you need to know some things, right? So in accordance with section 11, it says a person who is ascertaining the income of that person or of another person from a business, are you getting it? For a year of assessment shall deduct in respect of trading stock of the business, the allowance calculated. And the allowance is calculated by adding the opening value of the trading stock, which is opening stock of the business for the year, to the expenses in the person is using two devices. It should kindly lower the volume on the other one. So adding the opening value of trading stock of the business, I get it, for the year of assessment to the expenses incurred by the person during the year. Okay, that's your trading expenses. And included in the cost of trading stock of the business, right? Those are the expenses. And then from there, you are going to deduct from the sum obtained the closing value of trading stock from the year. Okay, and this is your cost of sales. Now, this deduction is the reason why when we are starting tax adjustment, we start with profit before tax and not our gross profit. Do you understand? Because this is an allowable deduction. So we are saying that when you take your opening stock, which is the closing stock from the previous year, also, we are going to add trading expenses for the year. And the reason why we don't have purchases, but we rather have trading expenses is because it might either be a manufacturing entity, okay, which produces, which is production costs, or it might be a merchandise entity which does purchasing, right? So when we say this, it means that we can either have what trading expenses that came in the form of production cost or came in the form of purchases, right? So trading expenses actually include the purchase price or your production cost plus, let's say there was what some carriage costs, okay, carriage costs. There was some exchange losses. Okay, these are all trading expenses. So usually the basic accounting that people do, okay, when you break up cost of sales, it has a lot of items. We have abnormal losses. We could have abnormal losses add back. We can have loss allowances in there. Okay. We can have transport or transaction cost, okay, transaction cost, other directly attributable costs, okay, directly attributable costs, okay. We can have non-refundable taxes, so non-refundable input taxes, okay. So when you have things like NHIL, Get Fund Levy, COVID-19 levy, right? All of them form part of the trading expenses that we are saying. So when we say trading expenses for the year, it's not only purchases, but purchases and any other costs that are incurred, right? And to get the total trading expenses, these are the things you add and these are the things you take out, right? So if there's a trade discount, let's say they gave you a trade discount, okay, you have what? You have to take it out. If you had things like return outwards, okay, you bought goods, you return some of them outwards, you have to what? Also take them out. Also, if you have some tax refunds or tax rebates, okay, let's say you have tax refunds or duty drawback, right? So they drew back the duty, the Commissioner General drew back the duty, all these things. I get it. So no one will give you this kind of detailed calculation in exam, but who knows? Sometimes they may take the custom side and decide to tell you to calculate the deduction for trading stock, and they will include all these things, right? So know that anything that increases your purchases, right, or your production cost must be put in your cost of sales, or it must be included in the trading expenses for the year. So once you are able to get these trading expenses, which in basic accounting, you forward your purchases, you're now going to less what? The closing stock. You're now going to take out the closing stock from it, and that gives you the deduction forward for trading stock in accordance with what? Section 11. I hope that is okay. Is everybody on point? Do you want to write this down or it's okay? You want to write it down, we can move. Since this thing you know already, right? Shall we proceed?
Yes.
So we have seen the deduction in respect of trading stock. Now, opening and closing value of stock. Now, the opening value of trading stock of a business for the year of assessment is the closing value of the trading stock of the business at the end of the previous year of assessment. And the closing value for this year is the lower of the cost of the trading stock at the end of the year of the market value of the trading stock. So in tax, we also value stock, right? In tax, we value stock like what we see under IAS 2, okay? So when it comes to stock valuation, okay, the closing stock that we are deducting here, right? Even without closing stock, you choose between the lower of the costs, okay, the cost of the items, or what? The market value. Okay, the market value. When we say market value, we mean the arm's length price, okay? So we are saying that, yes, just like IES2, and this market value, remember that with tax, when we say market value, it may be the net cost of the asset, right? Or the net market value, which in effect is the net disposal value or the NRV. So when you read IES2, it says, well, stock can be valued at the lower of cost and NRV, right? So we are saying that, yes, it is still the same valuation that we know under our normal IAS 2. Okay, so remember, if you are dealing with a question, remember, I'm just preparing for exam, right? And even in practice, when you are dealing with a scenario, you have to check the two, okay, the stock that you have. What is it being valued at, okay? So what do I mean by this? Let's take a simple illustration. So we have product A and product B by this company, right? So we have the costs. We have the cost being 12 cedis for this guy, being 18 cedis for this guy. Then we have the market price, okay? We have the market price. We have the market price being 40 cedis, this guy being 60 cedis. Then we have agent cost, okay? So the agent can sell for us, but he's going to take 60% of the commission, 60% commission, and then there's some disposal costs, or let's say repair costs, right? Repair cost of this guy's own is 10%, 10 CDs, this guy's own is 12 CDs. Okay, so with this being said, they said that what we have units of, the company has units of products A, 5,000, and product B, 12,000 in stock, right? So we are going to value the stock for tax purposes. Okay, so this is a simple illustration, which is just in line with our normal IAS2 or our normal this thing that we do. So now with this being said, what are we going to do? We said we can value the stock at what? The lower of the cost or the market value, which is the net market price, okay? Or your fair value less cost to sell. It still works here, right? It's the same as the open market value that you buy. Now we are saying that how much would the agent take? Based on the question, how much is the agent going to take?
60%.
60%. So that means I just want to compute on the face of. So 60% of the market price will be, if he sells at 40, he will take 24 CDs, right? Not so. And this one, he's going to take 36 CDs. Is that not so? Is that not so?
So no, so
Okay, so in that case, with that being said, let's get the market price. So what will be the market price? The net market price. So this one will be what? 40. So let me just come down here. So market price. So for product A, what becomes its market price? Is
74.
40 minus 24. Remember, those are costs that you will incur, right? The agent will take 24. Okay, then 10 CDs to repair. So how much? How much?
6.
How much?
The lower 6 cities.
6 CDs. Okay. 6 CDs per unit, right? Okay, 6 CDs per unit. Okay, then let's look at product B. For product B, the selling price was 60 CDs. We'll pay the agent 36 CDs, and then we can repair it for 12 CDs. So what becomes the net selling price or the market price?
12 cities.
How much?
12 cities.
12 CDs, okay. So let's see. When we look at the two, we see that which one was the lowest when we compare the two? For product A, what was the lowest? Was it the market value or the cost? Was it the market value or the cost?
Cost was 14.
Cost was 12, market value was 6. Which one was lower?
The market value.
Market value, right? If you look at product B, the cost was 18. Market value we computed was 12, which is lower.
Market value.
Market value. So in that case, the closing stock that we are going to value in our books, right? The closing stock that we are going to value in our books, let's gather it. We know that product A had how many units of stock in the books? That is 5,000, right? So we have 5,000 units, which will be valued at what? 6 CDs per unit. Okay, resulting in what? That's 30,000 CDs, not so. And then product B, we had how many units? 12,000 units, right? 12,000 units with each being valued at what? 12 cities per unit, right? And that gives us what?
144,000.
144,000. So that means that the closing stock, which will be valued in our books, will be worth what? 174,000, right? Okay. Now the rule is that, you see, initially, these goods would have been included in cost at 12 cities and 18 cities. Do you know that? Do you know that? The original cost of these goods, which is in our accounting books, okay, will be worth, product A would have valued it at 12 cities by 5,000, right? And that would be how much? 60,000 also. Product B, its cost was how much? Was it 18 cities? Yes. Product B was also initially at cost of 18 cities, but we had 12,000 units in stock, right? And that would be how much?
216,000.
216,000.
216,000.
When you add it up, you get what? 276,000, right? As being the cost, the total cost of the stock, right? That should have been the cost of the stock. But this cost has been written down to 174, right? So accounting wise, you would have a loss on inventory, right? A loss on inventory, which is like inventory being impaired. So this is impairment of stock, okay? Impairment doesn't only apply to non-current assets. This is what we call impairment of stock or loss on inventory. Some people call it inventory. This is a common term. Inventory write down, okay? Inventory has been written down because it has lost value in the market. And how much is the write down? It should have been worth 276,000, right? Now worth 174 in the market. So how much should be written down?
102,000.
So
102,000.
102,000, right? So 102,000
102,000.
102,000 would have been charged as an expense, right? This would have been charged as an expense in the P&L. So you see this amount that is charged as an expense in the P&L. The tax law does not really allow this until the inventory has actually been sold. Remember, impairment is not a recognized expense until the asset is actually sold. That is when the tax law identifies it, right? So this creates a temporary difference, okay, between the tax recognition and the accounting recognition. I'm just teaching you this just in case, because when a loss allowance happens on inventory, because the inventory is not actually sold, the tax law does not have any law that says that when there's a loss on your inventory or you value your inventory, right? The loss on the inventory should be captured as what? Allowable deduction, unless the inventory is actually sold. Okay. Sorry for taking you in too deep, but I hope it's understood. Understood?
It's a bit of management.
It's not management account, it's normal accounting. Don't worry. But I hope it's clear. It's a clarity that I want.
Sure.
Sure. Okay, so let's see something here. Let's look at the cost of trading stock, right? Now, one thing you should understand is that for the purpose of determining the cost of trading stock for a business, okay, any amount that is incurred in respect of repair, improvement, or depreciation of a depreciable asset is not to be included. So let me give you a typical example, right? We are in the business of selling cars, okay, and then we imported a car to sell. Remember, this, however, is our inventory, right, or our trading stock. But however, it is a depreciable asset in nature, right? True or false? Now, when you have to repair this car before you sell, you shall not include the cost of the repair, the improvement, or depreciation, okay, into this asset for tax purposes. Do you understand? However, they shall be charged as separate expenses, but you can't add it to the cost of the car and sell. I mean that if this is included in your cost of sales, they are going to disallow it for tax purposes because you are going to inflate the cost of the inventory. You haven't heard this one before, have you? So you can do it. Accounting, we allow this, but tax, it shall be disallowed.
Secondly, take it again.
I imported a car to sell. The car, I had to repair it at some cost, right? I had to do some improvement, change some locks, doors, pimp the ride, right? All those costs. If I'm doing accounting, I would have added it to the cost of the car, right? And added it to my purchases. True or false? Including the shipping, air transport, whatever. True or false? Is that not what you do?
True.
Yes.
But that is saying that so far as you incur that amount in respect of a repair, improvement, or depreciation of this inventory, which is your depreciable, your car that you sell, you shall not include it in the cost of this inventory. Makes sense? Does that make sense? Does that make sense? Hello? Hello?
Yes.
Aye.
It means that if you have to repair inventory before you sell, you cannot include the repair cost in the cost of the inventory. That's all. As simple as that. Makes sense? Okay, that's it. It says what? If we are determining the cost of trading stock, we shall use the absorption costing method. And absorption costing, in simple terms, is grouping cost according to production and non-production costs, right? So with absorption costing, you are saying that the cost of trading stock is just the what? Your production costs, like you are just getting your product cost, right? So direct material. So you have your opening stock, not so. You add your production costs. Okay, your production cost. So direct materials, direct labor, production overheads, right? You add all of that. Let's just add direct expenses here. The sum of all the direct expenses gives you your prime cost. Okay, then you add your production overheads. That's what they are saying, that they allow for tax purposes, right? So this one, when you add it, you get your prime cost. Then after you get your prime cost, you add your production overheads, right? And that one, okay, that gives you the total production costs. Production costs. Then you are now going to less your closing stock from it. Okay, so they said we should use absorption costing, right? What you do in class normally, where you take sales, less cost of sales, then you get your gross profit, come and less admin, distribution, and selling expenses. This is absorption costing, right? This is what the tax law allows. So anybody who uses marginal costing or management accountant costing will not be allowed. And also, when you want to value your stock, where the stock is fungible, okay, when we talk about fungible assets, assets are assets that you cannot distinguish one from the other, right? So let's say that if you sell a tin of milk, you sell tins of milk, right? When you sell tins of milk, what happens? Can you distinguish? Let's say you had this tin here, you bought another tin, not so. These ones came the same day, and another tin came tomorrow. Can you tell which one came today and which one came tomorrow? Can you tell which one came today and which one came tomorrow? Hello? If you have ideal milk, that you sell and you stock all of them on your shelf, can you point which one came today and which one came tomorrow?
No.
No, they are the same thing, right? It's just maybe you know that you bought this quantity this date, but they have the same label, the same taste, the same, unless it's been too old, right? But if let's say you bought some last week and you bought some this week, can you distinguish between them? Can you distinguish between them? You
No,
can't.
unless
You can't. So this type of assets are known as fungible assets. You can't distinguish one from the other. They are the same class. It's like when you buy class A shares. Let's say you buy 2,000 shares of class A shares, right? These shares that you bought, can you tell one share from the other? Or they are the same class of shares? Can you tell one share from the other, or they are the same class of shares?
The same
The
class.
same. And once
simple.
assets fall into the same class, for tax purposes, they are termed as fungible. Once they are fungible, you only can choose between the first in, first out method for valuing them and what? The average cost method. What they are saying is that if you bought this tin of milk for 2 cedis, right? You bought it for 2 cedis per unit. Okay, 2 cedis per unit, and let's say you bought 1,000 units, okay? That was on, let's say, 1st January 2024, right? Now, on 1st March 2024, you bought the same milk again, but it was what? You bought it for 6 cedis per unit, Ghana economy, right? You bought another what? 5,000 units, right? Then, let's say on 1st May, okay, holiday 2024, you bought an extra what? At 7 cedis per unit, you bought another, let's say 5,000 again, or let's just make it 3,000 units, right? At 7. Then finally, on today's date, on 7th May, okay, 7th May 2024, you sold milk, right? You sold some of the milk, but you ended up selling let's see, I said 1,000, 5,000, right? So making 9,000. So you sold 8,000 units of milk, right? At 12 cedis per tin, right? You sold 8,000 units of milk at 12 cedis per tin. Now the law is saying that, you see, this sales and these things that you've done, right? You cannot really look at it and tell you that, okay, the stock that is left should be valued at this amount. Do you get what I'm trying to say? So the law says that when it is shares, so when it is stock, you can use first in, first out or average cost. But mostly in your exam, it's first in, first out that you see, mostly in the valuation of stock. So after this, I will take a simple one on the valuation of stock, being it trading stock or shares, right? So if I have to put the date here, okay, put the details, that means whether it's a purchase or sale, put the number, that's the quantity of milk that I had, put the price, and also put the price and put the value here. Let's see what it will become, right? Sorry for taking you too deep. Now that's how your taxes, very deep. You have to understand these things. So what's the first date we bought? What's the first date? Please, quick. 1st January 2024, right? And how much was it a purchase or a sale? Bought, right? Quantity of milk did we buy? Quantity. Let me go up for you to see. 1st January 2024, we bought what? 1,000 tins, right? True or false? 1,000 tins at what? 2 cedis per unit. So what becomes the value? 2,000 cedis. Do you all agree?
Yes, 2,000.
Okay. Then did we buy some again? Yes, 1st March. We bought 5,000, right? So 1st March 2024, we bought again. How much did we buy? We bought 5,000 at what? At
6 cities.
6 cedis. 5, 6, that's 30,000 also. Then when again did we buy? 7th May, right? No. It was
1st May.
1st May. How much did we buy?
1st May, 5,000.
We
Or
bought
3,000. 3,000.
at 7 cedis, right? 37. Is it
21.
21,000? Okay. Were these the only purchases we made? Yes, only these 3. So at the end of the day, when I put down this together, what's the total quantity of milk we have so much? Total before sale. What's the
That's
total quantity?
53,000.
Okay, we have 53,000, right? Okay.
Sorry, the value.
Okay. Sorry. This would be like
9,000. 9,000
Okay, so we have 9,000 here.
quantity. Quantity is 9,000.
Okay, this will give us 53,000, right? Okay, so now how much was the sale? On 7th March, we made a sale, right? How many units did we sell? We ended up selling 8,000 units, right?
8,000.
8,000 units at what? 8,000 units would have been what? Let's see the value. 8,000 units would have been first come, first serve, right? Which one came first? This 1,000 came, right? So it should be the first that will go out. So 1,000 at 2. Meboa. So we are left with what? If we take 1,000 at 2, how much are we left with? We are left with what? 5,000 at 6 and 3,000 at 7, right? So we can we take all the 5,000 from this? Yes, we can, right?
Yes.
We have 5,000 at 6 CDs.
Yes.
Then we have what? 2,000 at what? At 7. Meaning that how much goods will we be left with?
1,000.
We'll be left with closing stock of how much? Of 1,000
1,000.
valued at what?
7 cities.
7.
Because first come, first serve, right? 1,000 came at 2 CDs. We took it out because 5,000 also came at 6 CDs. And then 3,000 also came at 7 CDs, right? So that becomes the total value. When we add all, what do we get? This one will be 2,000. This one will be 36,000. And this one will be what? 14,000. So that becomes the total value of the goods in terms of.
The middle one is 30,000.
It's rather 30. Oh, I said 36. Sorry. 30,000, right? So how much do we have? Is it 46,000?
Yeah, 46.
So when you take it out of the 53, what do you get?
That's 7,000.
Do you get 7? And you see that 1,000 CDs valued at 7 is actually 7,000. Can you see? Yes. So this is how you value closing stock when it is dealing with tangible assets. Asset that you cannot separate one from the other. And I hope it's not difficult. This one is basic accounting or basic management accounting, right? So that is it. Is it understood? This is how deep they can go when it comes to tax, right? You are going to do the FIFO yourself and value the stock and go and use it to get. So if a full question comes on deduction for trading stock, they can decide to bring this where you have to do it yourself, right?
So, but here the sale, we are looking at the cost component of this sale.
We are valuing the stock. We are not looking at the value. Unless there's realization, unless we are trying to sell, right? So if we are looking at the realization, then we know the cost, right? That the cost of these goods are worth this, right? And we are selling it at this. So let's say, assuming we want to find this, we are just realizing this stock, right? Realization. What we'll do is that we know that these goods were sold at what? 12 CDs, maybe one. So we are saying that, okay, if we want to get the cost of the sold stock, right? If we want to get the cost of the sold stock, we know that we sold what? We always sell for tax, we always use the market value, right? So we said that we sold what? How much did we sell? We sold what?
8,000.
We sold 8,000 units at 12 CDs each, Meboa. That would have been what? The value, 812.
72 or what?
96.
Sorry, 96.
So 96. And then what is the remaining amount? That's 1,000. 1,000 would have also been valued at the market value of 12. True or false? We would have been giving us what? 12,000, not so. Meaning that the total market value of all the stock would have been what? Total market value of all this stock would have been what?
108,000.
1068.
108,000. Okay. Something that is worth 108, you sold 96 from it, right? So if you have all the costs, I get it, of the goods that you had, right? You want to see how much of it you sold. The cost of these goods were worth 53, but you sold what? 96 out of it. So 96 out of the total market value of 108 times the whole 53,000 must give us the cost of the sold stock, right? And that is how much? 96 out of 108 times 53. How much do we get?
47,111.
That means the cost of these goods are worth 47,111, right? This is the cost of the sold stock. Okay, cost of the sold stock. So you are saying that if this is the cost of the sold stock, then what is the realization component, or the gain or loss on realization? So the gain on realization, let's see if we had a gain on sale or what? Loss on sale. So what's the gain? Consideration received. How much did we receive for this stock?
Go up.
We sold all for 96,000, right? Then we less what cost, right? And the cost of this, we have worked it to be what? 47,111, right? We take it out, we end up with what?
48,889.
Gain on realization of what? 48,889, right? So I've gone too deep, too deep. I know some people are confused, but let's take another example to make it clearer, right? I hope that sounds fair. I hope that sounds fair.
Yes, please.
So let's see. This time the stock we are dealing with is stock of shares, right? So Gloria Goodwill acquired ordinary shares of the same class. Ordinary shares of the same class, are they of fungible in nature or they are not fungible in nature?
They are tangible.
They are fungible in nature, meaning we cannot separate them from each other, right? So she acquired these shares of the same class in Unilever Ghana on a piecemeal basis at the following values and dates and amount, right? So this is what we have, okay? And then we know she acquired, they said what? So we have to put our pro forma down, right? And what's the pro forma? We start with what? Right? Then our details, then the quantity, right? Then what do we come? The price, then the value, not so. So what's the first date? June 2016. Did she buy or she sold? She bought, right? How many shares did she buy? Please go with me. How many shares did she buy?
200.
She bought 200,
200.
Yes.
200 shares. At what value? We don't know the value, but it gave us a total value of 30,000, right? Now, in April 2017, she bought again, right? How many? 400 shares at 45,000, not be so, okay? Now, in December 2018, did she buy again? Yes, she bought. How much? 150 shares, valued at 18,000 also. July 2019, she bought again, right? How much? 200 shares, 40,000 also. Okay. Now, these are all the shares before the sale, right? Before sale, how many shares would she have had? And this is the cost of these shares. How many? How many shares did she have? Quantity of shares did she have before the sale?
950. 950.
Okay, she has 950 shares. Okay, and they were all valued at one.
Okay.
They were all valued at 133. But how many did she sell? How many did she sell? Sale. She sold what?
300.
She sold 300 shares, right? Meaning that this 300 would have been what? Would have been 200 valued at, when you divide this by this, right? And then the rest of the 100 also valued at this one. Do you remember? Do you remember? But here we are not working the closing. We are not concerned about closing stock. We just want to value these shares, right? Now, we know that these shares were actually sold at how much did she sell the shares? She sold them for 45,000, right? But the market price at the time of their disposal was 200. So it means that if we want to value this now, we know that the remaining shares will be how much?
650.
We have 650 shares, right? So it means that this 300 would have been valued at the market price, which is 200, right? And this 652 would have been valued at the market price, which is 200. If you put it together, we should get the total market value of all the shares, right? So total market value of all shares. What's the total market value of all the shares? Three two. That will be 60,000, right?
Yes.
And then 650 and the 200 will give us what?
130,000.
130.
130,000. So if you put it together, we get 190,000, right? So this is what
Yes.
you are saying, that if, look, it's ratio that you are doing. You are saying if, what do we call it? If 950 shares, you are trying to tell us that if 950 shares were able to give us 133,000, okay, that's the total market value. If you like, you are saying that if 950 shares was giving us what? 133, then the 300 shares is going to give us what? Okay, that could still be used to get the same equivalence of the cost, right? But we found their market value telling us that if 190,000 Ghana cedis, which is the total market value of all the shares, is equivalent to what? 133,000 cost. Do you agree? Then the 60,000 that we are selling should be equivalent to which cost? We don't know, but it will be less, right? So if less, more divide. So you end up with 60,000 out of the 190,000 times the cost of 133,000, right? And you come and end up with the original cost of these assets that you are selling. And what becomes their cost?
It's 42,000.
42,000. That means the shares that you sold, its cost equivalent is what? 42,000. So now what's the gain on realization? We know gain on realization is just the consideration received minus what? The cost. Okay, we sold this for 45,000, right? And then the cost of these shares are 42,000. So it means you have a gain on realization of what? 3,000. Makes sense. So this is how we value shares under the Ghanaian tax law. I hope you learned something. So that is it. Are we okay with trading stock? Are we okay with trading stock?
But there's a question here. So where you dispose or realize two separate assets, one is a loss, the other is a gain. Do you net off, or how do you trade them?
Of course. It is better you treat them separately. They will end up, the net effect will be net off, because the gains, remember, if you're an individual, then you can decide to take the gain and the loss, less it, and then tax the net at 15%, 25% as at now, right? But if you're a company, you can include the gain as part of income, the loss as part of expenses, then it will be net off. That's why you have hedging gain and hedging loss always shown on the face of the statement, right? They net off automatically. So,
Okay, all right, thank you.
you're welcome, boss. Any question on trading stock? Yeah. So can we take this simple example? Oh, this thing is too easy. Mafio Limited had the following units of stock at the start of the year, right? He bought 5,000 bags of product A at 5 cedis per bag, bought 20,000 bags of product B as 10 cedis per bag, right? So this one, we know that's the opening stock, right? Then there were additional expenses, purchases, carriage, transport costs, shipping and handling charges. All these ones, what do we do? Don't we add? Are there no trading expenses?
Yes.
Expenses. Then at the end of the period, the following units were left in stock: 25,000 bags at 5 cedis and 10,000 bags at 10 cedis, right? So these ones are closing stock. So you see, you take your opening stock, these two products, add your trading expenses, And also get stock available for sale, less your closing stock. Then you get the deduction in respect of trading stock. Okay. Therefore, the amount allowed as an allowable deduction in respect of trading stock is 3 to 80, just like we saw. Now we have to do research and development. You hardly do you see this in questions because they are straightforward. Now, when it comes to research and development, okay, I'm going to teach you some new rules which are not directly in the tax law, but it works in practice. Okay, so remember, all the deductions that you see in practice, there are other things that we also consider, right? The accounting aspects, which I think students should also be aware, okay, when you have to defend yourself in a tax case. Now, R&D expenses are addressed in section 30, allowing for their deduction under specific conditions. So let's look at the key points. Okay, the deduction criteria is that R&D expenses are deductible if they are wholly, exclusively, and necessarily incurred during the year in respect of your R&D, like when you are doing your normal research and development, right? Whether you are producing income from business or investment. But however, if R&D expense, I get it, is of a capital nature, it might still be deducted. There's difference between R&D expense that is of a capital nature and R&D expense that is to be included in the cost of an asset. Let's understand. Now, R&D expenses encompass costs that are incurred in developing the person's business. Hey, please, somebody's background. So when you incur costs, right, to develop your business or improve your business products or processes, it means you are doing research and development. Now, we know that research and development, right? You see, when you look at exclusions under the tax law, it tells us that R&D expenses do not include costs that are otherwise included in the cost of an asset. That was used in the research and development process. So if you use an asset, right, and you have to incur costs to improve that asset to use in the research equipment, right? You had research vehicles, you have other costs, right? Research expenses that are of capital nature meet the definition of development expenses. Okay, so if they say exception when it is of capital nature, they are just talking about development. So development expenses under our normal accounting, it must meet some criteria, right? Some people use PIRATE, some people use sale criteria, technical feasibility, all that, right? By PIRATE, it says that the asset, it must be probable that future economic benefits are going to flow to the entity from the use or sale of that asset. There must be intention to complete that R&D. Also, you must have the resources to carry out that R&D. There must be what? The ability to complete that R&D. There should be technical feasibility, right? It should be technically feasible to complete that R&D. And then expenditure should be measured reliably, right? Now, when these criteria are met, before development expenses can be recognized. Now, still under tax, this thing is there, but it's hidden. If we say R&D, even if it's of capital nature, might be deducted. When it comes to R&D, this is the residual deduction rule. Now, for something to qualify as deduction under development, okay, whether it is development or R&D, the law allows it as a deduction. But however, if only it is of a, like it is included in the cost of an asset, right? So that cost was added to, let's say we had development or improvement expenses, right? That are development in nature. And we built, maybe we ended up building an AI machine, right? We ended up building a robot. And then we went to add this cost to the robot cost. The law is saying that if that is the case, then we shall not be able to deduct this R&D. Meaning this one is according to the policy of the organization to say that, okay, that development cost is of capital nature. Let's add it to the cost of the AI machine or less expenses, right? So if the expenses, the tax law allows. If they include it in the cost of an asset, the tax law does not allow. Okay, so this one is discretional in some nature, right? It is the entity's choice or the entity's policy that will show us whether this R&D expenses that they are incurring is supposed to be included in the cost of an asset, or is supposed to be normal development that has to be expensed. Okay, so R&D, that's all about it. If you get a question regarding R&D, make sure that you speak your mind. Tell the examiner that underlying assumptions you used in expressing or expensing this cost of capitalizing them. It depends, right? So let's look at how do we deal with company website costs. Okay, let's say a company has a website. Okay, there are some rules in tax that you have to understand. Now, when it has to do with application and infrastructure costs, okay, so the capital expenditure include expenses related to your domain names if you pay for the domain, hardware and operating software that directly contribute to the functionality of the website. Those are the capital costs, right? Which is the application and infrastructure costs. And then when you have design and content development costs, the cost you pay to the graphic or website designer, right? That he takes huge amount for, right? Those ones are generally treated as capital expenditure to the extent that they end up creating an enduring asset, a long-lasting website you are going to use for a long time. Now, these things that you are seeing, right? Making reference to accounting, we can make reference to the standard interpretation number 32, okay, SIC 32. Now, this one has a particular rule in dealing with website development costs, right? In dealing with website development costs. Now, anytime you are doing this sort of thing, developing websites, and then you pay a huge sum to somebody to do it for you. So far as it creates an enduring asset, it is an allowable, I get it. I say an allowable deduct, a capital asset, meaning you can grant capital allowance on it. So you see some questions and you see capital allowance, they write accounting software or they write website for the company, right? Then you see the cost there. Then you go and treat it under pool 1. Why pool 1? If you don't have any pool, you can treat it about, it's an intangible asset of some sort, right? But it came because of research and development. Okay, so there are some revenue allowances for initial research and planning. So expenditure incurred on your initial research and planning before deciding to proceed with website development is treated as revenue expenditure and is allowed for deduction. So these are general rules on deduction, which you cannot find directly in the law, but there are things that we do normally in practice, right? Now, a website designed to directly generate sales, subscription, advertisement, and income is supposed to what? Create an enduring asset. It's something that you enjoy future benefit from it into the future, right? We treat it as a capital expenditure. But when you incur costs for maintaining the normal running, adjustment for price changes, maybe running maintenance fees for the website, I get a small adjustments and pending reviews, those things, we just expense them, right? And every tax person should allow it because it's part of the normal. We are in the digital era. That's why I'm teaching you these things. Anka, we're here, right? We are in the digital era. When you get a client, now almost everyone is going digital. And these are some of the things that as a tax practitioner, you have to know, right? Add it to your toolkit. I hope that helped. So in summary, when you have website costs that can create an enduring asset, like you use it for a long time, it's not just a website for information that you use within the next 2 months, okay? There are actually different kinds of websites that we have, okay? Basically, in this modern era, we have what we call static websites. Static websites are for just display of information, okay? This one's cost less. Mostly, we could say this may be a landing page or a product funnel which directs people to buy something from you. And we have the second type, which is what we call a dynamic website. Okay, with dynamic website, the content keeps changing, like a blog or a news website. You know, the content is not the same. It keeps changing. Every day we update, right? So this one is not just for display because things keep changing, okay? So this one can create a long-lasting benefit for you because things keep being updated, you keep giving people news, you keep giving people information, let's say videos, some things that keep changing, right? Then the third type of website we have nowadays is e-commerce sites. So you can have you can have a combination of all three on one site. But nowadays you can have dynamic or e-commerce sites where you sell products, right? Or services in there. So these are basically the types of websites you have in this digital era. Before, all websites used to be static because around the early 2000s, they started bringing dynamic websites being created by PHP, which was known as personal homepage, but now it's hypertext processor, right? It's a programming language which powers about 70% of the web. But now almost all websites are built with other languages like Django using Python and JavaScript and even Iconic and then Flutter and the rest. Now, as a tax practitioner, your duty in the digital era is to know how these things are going to impact tax costs for your clients or when you are an auditor too, you should know which costs are allowable and which you shouldn't just say disallow all. No, it doesn't work because it forms part in the production of income. Without, let's say, if I have a website that I sell courses on, right? You cannot just tell me to disallow the website cost. Why? Because it is the main generating content. It is the main source of income for me. Do you all agree? Do we make sense? Now, after COVID, many people have gone online. So if the person has this online cost or website cost, are you going to tell him to disallow them? Answer my question. Are you going to tell the person to disallow them?
No.
Why?
Because they form part of your business income generation.
Yes, because they are wholly, exclusively, and necessarily incurred. The whole of the amount related to the business, it's exclusive, it is particular to the business because he's using it to generate his own cash flows, not someone else's cash flows. And it is necessary because in this era, if you do not have that website, you can collapse, true or false. Meaning it's inevitable. The business cannot do away with it. Meaning it meets the residual deduction rule, and then because of that, it qualifies for a deduction. I hope that makes sense to everyone. I hope that makes sense to everyone. Okay. Now let's look at losses from realization of assets or liabilities. The whole thing is that when you have a gain, when you realize your capital assets, okay, just like the shares we saw, you see, we had a gain on realization. If you are an individual, you have the option to tax it separately at 25% as at now, before it was 15%. But if you're a company, you have to add it to your income, right? Now, if you have a gain, you add it to your income. The law is saying that therefore, if you also have a loss from a business or investment, that loss, are you getting it, can be deducted from your what? From your income, right? As an allowable deduction. So if I have a gain, I tax it separately, I add it to my income. The same way, if I have a loss, I can also what? Deduct that loss as allowable. That is a rule. I hope this is not something difficult. Any question on losses? Any question on losses?
So, but Bill, the treatment, if you have investment losses and business losses.
I'm saying if it's loss on disposal, not the normal way loss, but when you dispose of an asset, either from your business.
Oh, okay.
Yes, that's what I'm saying.
Okay.
Yes. Any other question? Any other question, or that is okay? Okay. Now, the next thing we have to talk about is repairs and improvements, subject to capital allowance, right? Now, a person who is calculating the income of a person shall deduct from that income any expense that is incurred by that person for the repair or improvement of a depreciable asset of that person. Where the repair or improvement meets the requirement of Section 9, that's the residual deduction rule, irrespective of whether that repair or improvement is of a capital nature. Okay, so we are saying that anytime you do repair or maintenance on an asset, irrespective of whether it is capital in nature or not, it is allowable, but there's a caveat. Okay, despite the above, a deduction granted for a year of assessment with respect to a depreciable asset in a particular pool of depreciable asset of a person shall not exceed 5% of the written down value of the pool at the end of the year. Okay, so always you have to do repairs and improvements, separate working to get the pool at the end of the year. Apply 5% on it, and that becomes what? The revenue portion. Now, we talked about revenue and what? Capital expenditure. Okay, revenue expenditure expenses that are incurred within a year, normally for the day-to-day what? Maintenance of your business, right? And capital expenditure are the ones that are used by that secure benefits more than what? More than 1 year or more than one accounting period, right? So these are the capital in nature. Now, anytime you do repair and improvement or repair and maintenance, the expenses are mixed up, right? So there's revenue, there's capital, all mixed up when you do repairs and improvement. Now, the tax law cannot tell because the taxpayer can lie that this portion is capital portion so that you can enjoy more capital allowance. This portion is revenue portion so that you can enjoy deduction. So the law is saying that yes, if you do repair and improvement, this refurbishment cost or this restructuring cost have capital portion and revenue portion, but he's limiting the revenue portion, are you getting it, to only 5% of the pool. Do you get it? Remember that revenue expenses are charged in your P&L. The law is saying that this revenue expenditure shall be limited to 5% of the pool. So any repair that you do, 5% of it, are you getting it? 5% of the pool to which that repair belongs is always revenue expenditure. Then the excess above the 5%, right? The excess above the 5%, which is 95% of the pool, are you getting it? I said 95% of the pool. That is the excess above the 5%, which is 5% of the pool, okay? Compared to the repairs that you charged in your account, okay? That excess repairs shall be added to the pool and granted capital allowance. So it's like the law uses this to split how much can be deducted and how much can be added as a capital allowance expenditure. Okay, and this is an anti-avoidance rule to make sure that people do not deduct more than 5% of their repairs and development, repairs and maintenance or repairs and improvement expenses as revenue expenditure. I hope that is understood. I hope that is understood.
Yes, please.
So let's take a question, right? This one is a simple question. Bill Cobby Limited incurred expenses on repairs and improvement of 6.5 on a plant and machinery and also declared a profit of 100,000 for the 2016 year of assessment, okay? For the
It appears Boss Bill is on mute.
Yes. I hope that it's not by mistake. Would you want to try reaching him, or maybe he has a call, an urgent call or something?
Okay.
hello? Hello?
Yeah, Boss Bill.
I think you can hear me.
Yeah,
Sorry,
we can hear you now.
there was some small interruption. I had to make sure I did.
Okay.
So what are we saying? We are saying that there was repair or improvement of 6.5 on a plant and machinery. Which pool do we put plant and machinery? Which pool do we put plant and machinery? It depends, right? If it is normal plant and machinery, it will be in pool 3. Do you get it? But if it is what? Manufacturing plant and machinery, then it will be in pool 2. True or false? Please always keep this in mind because most students, immediately they see plant and machinery, then they want to put in pool 2. No, it doesn't work like that, right? You have to check which pool the plant and machinery belongs to. Do you understand? That is it. And they are telling us that what? The written down value of the applicable pool before capitalizing any excess is 60,000. That means they've given us the pool already, the written down value. So it means that when they took the written down value brought forward for that pool, right? We don't know what pool that is, but roughly it's pool 3, right? They brought the written down value. Maybe the written down value was some amount, not so. Then there were some additions, okay, during the year. They added these additions. There were some disposals. They took out those disposals, right? I think this is what is making people make mistakes when it comes to repairs and development. Why do I keep saying repairs and development? Research, sorry, research, repairs and improvement, sorry. Now, the commissioner should have made this working available, right? But he only provided this one. So people still keep making mistakes because they don't know how to get a written down value at the end of the year. Now, you get capital allowance. This capital allowance is not real. It's a notional capital allowance, meaning that you just compute this capital allowance just so you can get the written down value at the end of the year, right? And this is what the question has given to us at that 60,000. Do you all agree? So the 60,000 you see in this question, they would have done all this working to arrive at this 60,000. Do you all follow? Do you all follow?
Yes.
So we are saying that what's the allowable repairs? That's 5% of the 60,000, right? And that gives us how much? About
3,000.
Okay. So once we get that amount, how much was charged to the P&L, charged to the account? How much was charged to the P&L? They said 6.5, right? Meaning what's the excess repairs? Excess repairs to be added back to the pool, which is of capital nature. How much? That's 3,500, right? Do you all agree? So it means that if I want to do my profit adjustment or calculate my profit for the year, right? When I take my profits before tax, which was the 100,000 also, can just decide to add back this 3.5, I'm done. Or the best way I always prefer is to add back the disallowable deductions, right? I'll add back all the repairs, also, which is the 6.5, right? And I end up with 106,500, making what? That becomes my adjusted what? Profit. Then I'm now going to less what? Other allowable deductions, right? And the other allowable deductions, if there was capital allowance, I would less it. Then the allowable what? Repairs. And the allowable repairs, we all calculated it to be what? 3,000. So we deduct 1,000 and we end up with 103,500 as the allowable, as the chargeable income for this guy. Okay, so as simple as ABCD. Now, this is all about research. I keep saying research, repairs and improvement. I hope that is okay. So let's take a more standard working, which will give you more grease, which will give more grease to your elbow. Let's see. So below are the written down values. I hope you can see the question very well. Below are the written down values of assets in the various pools at 1st January 2016. So we have class 1, class 2, class 3. And included in repairs and improvement is an expense of 38,500 or repairs on manufacturing equipment. Okay, in class 2, and no new assets were acquired in 2016. So to compute allowable repairs, right, we do two things. So step 1, computation of what? Of allowable what? Repairs, right? And it's 2 steps. Always first, get the written down value at the end of the year. So first, I must get the written down value at end of the year, okay? And what I do is that, what pool am I referring to? What pool was the repair done in?
2.
2. So pool 2, we know pool 2 is what? 30%, right? Okay, so you are going to bring the written down value brought forward. And what was the written down value brought forward for these assets? 30,000.
30,000.
Okay. So since there were no additions or disposals, we just get our notional capital allowance. Remember, this capital allowance is not real. Okay, so we just take 30% of this 30,000, and that gives us what? That's about 9,000 or so. Take it out. That gives us the written down value at the end of the year. That gives us 21,000 also. Okay. So what becomes our allowable repairs is what percentage? And this working, you see some people doing it in the capital allowance schedule. No, it will confuse you. There's a way we do it, right? If you want to use the capital allowance, no. You just go and do this working separate. When you finish, then you put it in the schedule. Are we okay? So allowable repairs, that's the next thing you do. So what's the allowable repairs or the limit on the repairs? 5% of the 21,000, right? And that gives us how much?
1050.
1050, right?
Yes.
And how much repair was charged to our P&L? They said they charged
38,500.
right? Okay, so out of 38,500, we are saying that what? 1,050 relates to revenue, what? Expenditure. Do you all agree? So how much
Yes.
go to capital expenditure? How much is of capital nature? Which becomes what? Our excess repairs. That's how much? 37,450. That's it. Agreed. Makes sense. Makes sense.
Yes, sir.
Yeah.
Okay. So with that being said, let's get our capital allowance. So company name, we don't know the company's name, but computation of capital allowance for the 2016 year of assessment. Basis period 31st 12. So we have the pool 1 being 40%. We have the pool 2 being 30%. We have the pool 3 being 20%. And we have the total capital allowance, right? Okay, so we bring our written down values brought forward. We have what? Class 1 being 10,000, class 2 being 30,000, class 3 being 20,000, right? Where this is only for capital allowance. I see some students who add the total and put it there. No, it's only for capital allowance. Were there any additions during the year? No, right? Any disposals? No. But we had excess repairs, right? To which pool? You put the work in. Which the repairs, right? Pool 2. The excess repairs was 37 what? 450. Not so. Okay. Out of the total repairs. So we add up. This one still gives us our normal 10,000. This one gives us 67,150. This one gives us 20,000. Not so. I hope that is understood. So with that being said, this gives us our depreciation basis. And then we are going to grant capital allowance. It's for the whole year, right? Always check how many days they operated. This one, it seems, is the whole year. So 40% of 10,000, that's 4,000. And that gives us what? 67,450 at. So this one gives us 4,000, right? That gives us what?
20235.
0235. Add it to 8,000.
28235.
Right? So this is a total capital allowance, which is going to be deducted from our profit for the year. Okay, so that is about research. Do I keep saying research? Repairs and then improvements. Okay, so any question? This is how you do it in a normal pure capital allowance setting, right? You go and calculate it separately and come and include it in your computation. Okay. Are we okay? Any question? So let's look at practice, tax practice, okay? Not just normal tax that we are looking. Now, when you incur initial repair cost on a purchase asset, provided it's not trading stock like we saw earlier, right? It will be deemed to be of capital nature if any of the following conditions apply. Like the purchase price was materially affected or reduced because of the property's dilapidated state. The property was not in a fit state for use in the trade until it was repaired, and the property could not continue to be used in the trade without being repaired shortly after acquisition. And the purchase requires the new owner to undertake repairs, right? So this one is asset that you are going to be using in your business, so not the one you are going to sell. Okay, so with assets that you are going to be using in your business, if you incur repair costs on the asset initially, they are capital in nature, right? That one, they shall not be subject to the normal 5%, right? Because the asset is yet to be used. So there's no sort of maintenance cost. It depends on how you treat it. So this one is subject to accounting policy, right? So remember these ones. So a repair to an asset that restores it to what it originally had been is normally an allowable revenue expenditure. For example, the cost of replacing roofing sheets blown off by a storm, okay? The cost of alterations for improving or changing an asset will provide an enduring benefit to the business rather than simply restoring it to its previous state. Such expenditure is capital in nature. For example, extending the area of the roof or taking off the roof and building another story. This one, though, is repairs and improvement. It is improving the earning capacity of the building, right? Remember, we talked about that regarding website cost too. Now, a repair or replacement of an asset or a part of an asset using modern materials may look like an improvement. But if the new materials are broadly equivalent to the old materials, then the cost is usually an allowable expense. For example, replacing single glazed windows with double glazed windows, right? It's more like maintenance. Now, if any repair work results in renewal or replacement of an asset as a whole, then the expenditure incurred should be treated as a capital expenditure, okay? So if it mostly looks like some sort of addition to the value of the asset, right? It's like a new asset being acquired. But for exam purposes, it's either you give this underlying assumption or you just apply the 5%. Me, I think if you see any repair or improvement in exam, just apply your 5% and take the excess and write your assumption. Then you are good to go, right? These are tips for practice, right? As I'm teaching you tax, I'm not only teaching you tax for the exam, I'm teaching you tax also for practice, right? So in practice, these are some of the additional things that you have to know. I hope that makes sense. I hope that makes sense. So we looked at bad debts, the general rules on deducting bad debts the last time, but I'll go over it again. So when we say bad debt in tax, what is bad debt? It refers to a debt claim. Debt claim is simply money you have given to somebody, okay? Or a receivable, in respect of which you have taken all reasonable steps to pursue payment and which that payment will not be satisfied, okay? So there are some types of bad debt considered in the Ghanaian tax laws. Either they are specific in nature or they are general bad debts, okay? What are the circumstances under which a debt can be considered as bad? Now, after you have taken reasonable steps for recovery, a debt can be considered as bad on the occurrence of the following. One, either the debtor has died without leaving any asset from which the debt can be recovered. The person died and there were no assets to recover your money. Two, the person was bankrupt or he went out of business and there was no asset for you to recover your money. The debt is statute bad, meaning there are some statutory limitations on the debt that cannot make it or render it impossible to collect, right? That means the law has its hand on the debt, or there are some rules that you have to meet, or there are some limits, right, that the law has put on that debt. Also, the debtor cannot be traced. He's lost and you cannot find any asset. You cannot find his family members to take your money to. And any attempt at negotiation or sending him to court didn't work, right? And any other circumstance where there's no likelihood of cost-effective recovery. The person threatened you such that you are scared to go for your money. It's all part of it becoming a bad debt, right? You sent a debt collecting agency. They beat all of them and they send them away. You cannot take your money, right? You sent your money to a mafia. To no work. Now, what are the conditions that the commissioner, after looking at all these conditions, he may still say it is not a bad debt. There are some conditions that must be there for the commissioner to say this debt must become a bad debt, or he has accepted it as a bad debt, right? If you should have included amount in your income and you have accrued it. 2, if it is in respect of advances that you make in your normal course of business, right? Rather than ones that you made on a capital account, like a reduction to your shareholders account. We are not looking at that one. We are looking at normal advances you do in your normal course of business, normal loans you have given to people as part of your normal course of business, right? That is usually, this one will be in relation to a bank or a credit union or something, right? Now, you have taken necessary steps to pursue the payment of the money, okay? The debt claim or entitlement cannot be satisfied, and it relates to a specific bad debt. A specific bad debt, you know the person, not a general one. A general one, you can say, oh, 10% of my debtors cannot pay me today. Are you a magician to tell that 10% cannot pay? The tax law does not allow estimates. There are only certain circumstances the tax law allows estimates. But even that one, until proven, right? Okay, so estimates are not mostly allowed. So if you see general bad debt, disallow. Specific bad debt, you add an underlying assumption when you are solving a question that you assume the person took all the reasonable steps to claim the money. So what are these reasonable steps you are talking about? 1, you follow due process in terms of your credit policy. You assess the person before giving him that loan. You issue reminder notes. You sold the debt to people to go and take it. They couldn't take it. You restructure the debt restructuring schemes. You reschedule the debt payment. You did negotiation or arbitration, right? Took legal action, filed civil suit. You obtained a judgment from the court, sent it to the person. The person still couldn't pay. So you've done everything that you could do. The person could not pay the money. If that is so, the commissioner can allow you to deduct that bad debt. I hope that is okay. So there are some few tax accounting rules when it comes to bad debt under Section 23, which are tax. There's difference between tax and tax accounting. Please, you should understand that tax is different from tax accounting. So when it comes to tax accounting, it is where there's a clash between tax and accounting rules. Okay, when such things happen, how do you deal with it? And this is where we are concerned about reversal of amounts that also include bad debts. Okay, so these are specialized areas in taxation, but I think we should just have a go at them. Okay, so what does it say? Section 23. Now, where a person deducts an expense, in calculating the income of that person and that person later recovers that expense, you shall, at the time of recovery, include the amount recovered in calculating your income. So you wrote 5,000 off as an expense. Later you received it. The law says just include it as an additional income, right? Make sense? Make sense?
Yes, sir.
That's all. Now, 2, where a person includes an amount in calculating the income and that person later refunds the amount because of a legal obligation to refund, you may, at the time of the refund, deduct the amount refunded in calculating the income of that person. Does that make sense? So look, I said you were owing me 5,000. I wrote it off as a bad debt, right? Later you came to pay me, and then I realized that you were not owing me and I gave you back the money. The law is saying that charge it again as an expense because you still paid back that money. Makes sense?
Yes.
Of course. So the thing is, eba pakahu, ekwa tifrim. That's all. When it comes, you add. When it leaves, you deduct. When calculating income on an accrual basis and you deduct an expense that you are obliged to make, and you later disclaim an obligation to incur that expense, you shall, at the time of the disclaimer, include the amount disclaimed in calculating the income of the person. So we are saying that you claimed there was a bad debt, right? And you charged it and later claimed there wasn't a bad debt, then also disallow that bad debt, as simple as possible. Make sense?
Yes.
That is it. These rules, when you read it, it doesn't make sense. I'm just summarizing it for you. Now, this one, okay, it says that what? Subject to subsection 6 and 7, the person may, at the time of the disclaimer of or write-off, deduct the amount disclaimed or written off in calculating the income of the person. And this applies where you are calculating income on an accrual basis and you include an amount which you are entitled, right? And then you later disclaim an entitlement to receive that amount from another person. or in the case where the amount constitutes the debt claim of a person, you write off the debt as a bad debt. So in simple terms, when you have to receive an amount and you couldn't receive it and you wrote it off, okay, as a bad debt, do you get the idea? When you have to receive an amount and you didn't receive it, or you have charged it and you didn't receive it, they are saying that reverse it. That's all they are saying. Do you get the idea? So if I have charged an amount which I'm supposed to receive and I treat as received and I didn't actually receive it, then I expense it. But if I charge an amount that is a bad debt and I later receive it, I must just include it in my income, right? So when it comes to the issue relating to banks under Section 87, you shall not claim an entitlement to receive an amount or right of a debt claim as bad debt unless the commissioner is satisfied that you have taken all the reasonable steps in pursuing payment, and you know these reasonable steps, right? Have we not discussed it? Have we not discussed these reasonable steps? What are some of them? What are some of the reasonable steps?
If you have followed due process in respect of.
His credit policy, your credit policy.
Yes.
What else?
Issuing reminder.
Issuing reminder notes.
Resorted to debt collection agencies to no avail.
Okay. Legal suits, court order, also issuing reminder notes, all these things here. Or the entitlement can literally not be satisfied. Are we okay? So that was about bad debts. There are some other issues that I want to talk about. Now I need to talk about how to deal with long-term contracts. Now, before long-term contracts, there are some other rules on deductions that we are going to look at. Before that, let's take a simple question regarding bad debt. Demaxus, right? The result of Demaxus Limited indicated the following in its tax return or its financial statement for the 2019 year of assessment. So we have its profit before tax being 4,250,000. And the following deductions were made before arriving at the profit before tax. So we have the bad debt, general provision being 500,000 and specific provision being 1,750,000, right? And a further analysis by GRA revealed that the specific provision included an amount of 750 for which all reasonable steps could not be taken by Demaxus to pursue the debt claim. Okay, so the question is, we should indicate the adjustment that are needed to arrive at the assessable income of Demaxus. So what are we going to do? So what I am going to do is first, I'm going to take the profit before tax. How much was the profit before tax? How much?
4,250,000.
So 4,250,000, right? Then I'm going to what? Add disallowable deductions, right? Disallowed deductions. So disallowed deductions, I'm going to take what? The general bad debt. General bad debt we do not allow, right?
Yes.
How much was the general bad debt? That was 500,000. Then the specific bad debt, we can disallow only the portion that we could not take all reasonable steps. So if I like, I'll disallow all. Okay. The specific bad debt, I'll disallow all, which is 1,750,000. Okay. So that I can only take the allowable part. So this gives us what? 2,2. To give us 2,2 what? To give us 2,2 what?
225.
50.
Okay. So when we add it together, that gives us our adjusted profit, which gives us what? 6,500, right?
500.
Then we less allowable bad debt, right? Allowable bad debt. And the allowable bad debt is the specific portion which is allowable. They are saying 1,750, right? 750 should not be allowed. That means 1 million is allowed, right? So we end up with 5,500 as being our what? Assessable income for tax purposes. Makes sense. Understood.
Yes, sir.
So let's go to deduction for rent expense. Okay. Now, when it comes to rent, we know that rent is an amount paid in respect of land or premises that are acquired for the purpose of producing your income, and it is allowable, provided that all the rent is wholly, exclusively, and necessarily incurred. So if you are using part of that place for your private residence, then you have to apportion. That's why most questions you say that they say 20% of the house is for business and 80% is for your private residence. So that 20% is what we need, right? You apportion. Let's look at where students get a little confused. Legal and professional expenses, okay? So when you go to most questions, they'll tell you that, oh, you incur some legal fees. So let's look at when legal fees are allowed and when legal fees are not allowed as deductions, right? These are gray areas. People mostly do not talk about them. They just talk about the normal expenses. You have to know every kind of expense there is, okay? Then I'll be satisfied that if you are my student, there's no expense under this earth that will bring to a tax question that you cannot deal with. Do you understand? So let's look at legal and professional expenses. Now, these expenses are allowable provided that they are incurred in connection with the trade. So if it is in line with what you do, or it is in line with your trade, then you allow them and should not be related to capital items. So legal expenses are allowed in the following cases. When you are defending rights to your asset, somebody is trying to fight with you with like your asset, right? You are defending title or rights to your asset, or you are protecting your asset, or you are collecting trade debts. Okay, somebody's owing you are trying to collect the money, or current company matters, or any related business, somebody owing you money like retainer fees, disputes, they do not want to pay you your fees, all those things, right? Let's say you paid somebody, you paid a consultant to be working for you on retainer basis, and the person failed to abide by it, you breached this contract, right? When something like this happens, the legal fees that you sue the person is allowed because it's in relation to your business service, right? Let's look at when they are not allowed. If you are forming a company, the legal fees that you incur in forming a company or a partnership is not allowed. If you are selling your property or acquiring a new property, the sales taxes, the transfer taxes, the withholding taxes that you pay, right? The legal fees that you pay with relation to those expenses are not allowed. If you have an income tax appeal, you raise an objection to the GRA, and then it goes to the cost you incur, you cannot allow it. When you breach a tax law and you pay legal fees, not allowed. When you pay legal fees because you issued shares in a company, it's not allowed. I've given you all the circumstances where legal fees are allowed and circumstances where they are not allowed. So in a question, just open your eyes. Open your eyes. Makes sense. Any question? Any question? Are we okay with legal fees? Are we all okay with legal fees?
Yes.
Okay. Can we go?
Yes, sir.
Okay. Now,
Please, can you,
let's
sorry.
you
Please,
said
can you come again on the legal fees? It's not very clear.
in terms of which one, which is not clear.
The disallowed part.
We are saying that where you are coming to form a new company, right? Or you formed your company and you incurred some fees at the registrar general, all those kind of costs, right? You cannot charge it to your P&L. If you do for accounting purposes, yes, it's a legal fee, but the tax law will not allow it. Belinda, are you okay? 2, if you sell your property or you are acquiring a new property, right? Indenture, other costs that you incur that are legal costs, you do not what? Include them, okay? So the seal costs, when you go to the Commissioner of Oaths, those legal costs, the small costs that you incur, we do not allow them for tax purposes. If you raise an income tax appeal or the commissioner calls you to court and you incur some costs, you cannot charge it to your account. When you breach any tax law and you incur any legal cost, it's not allowed. When you issue fresh shares in a company, there are some legal fees that you pay, some seals that you pay for, right? Because they are share transactions. Those fees are not allowed. Belinda, are you okay?
Yes, please. Lastly, what do you mean by the ones that are allowed, the protecting assets?
Okay.
What?
Let's say there's a dispute relating to your company land, and then you drag the person to court. You need the services of a lawyer, right? You also need to incur some cost. That cost,
Yes.
as far as it's a business asset, it is allowed. If it's your personal asset, we cannot allow those costs. Are you okay now?
Yes, please.
Anything relating to your current business, we allow. Now, anytime you incur some fees in connection with the acquisition, alteration, or enhancement of how your business ownership is structured, okay, there are some fees that you have to look at, which are mostly disallowed, right? So when you incur costs in the forming, varying, or dissolving of a partnership, is disallowed. When you incur costs to incorporate a sole trader or partnership business, disallowed. A partnership becoming a limited liability company, the cost you incur, disallowed. When you defer a petition by shareholders to wind up a company, disallow. When you negotiate a merger between companies or partnership, disallow. When you form a registered company or change a company status, for example, change from limited to unlimited status, disallow. So any change in ownership situation, disallow. Nti ase aba fie. We are looking at too many expenses, eh? Yes, there's a reason why. Nowadays, your questions are loaded, packed with so many expenses that if you are not careful, you may not get them, right? That's why you need it. So anytime you see that we have changed the acquisition of share structure in our business, or we merged two companies, we incurred some costs, they are not allowed. Adverts are always allowed unless they were made by permanent neon signboard, which you know it will be a proof for asset, right? So in questions, that's all they bring most of the time. What about education and training? Now, where the attendance of the course is intended to give the business proprietors new expertise, knowledge, or skills which they lack, which may bring into existence an intangible asset that is of enduring benefit to the business, there is a view that that expenditure may be a capital nature asset, right? It's rare to get this, but mostly business expenses that relate to training in relation to your field are allowed. Like, let's say I'm a tax person and I go and do a tax course, right? The education and training course can be charged to my business, right? Okay. But when I go and do sewing, it doesn't relate to my business, it shall be disallowed. Okay, so when the attendance is merely to update your expertise, which proprietors already possess, the expenditure is normally regarded as revenue expenditure and will be deductible if it satisfies the residual deduction rule. It was wholly, exclusively, and necessarily incurred in relation to what? The generation of income in your business. Please remember this. Now, there may be some incidental associated expenditure incurred when disposing of an asset, okay? So the there's incidental associated expenditure when acquiring or disposing of an asset should be treated as capital expenditure. This one we know already, right? When we are doing realization, the cost of an asset includes three types of costs: cost of acquisition, cost of alteration, and incidental expenditure. Any other expense that you see, if it's not familiar, assess whether it's wholly, exclusively, and necessarily incurred, and then it should be fine, right? Okay. So we have to look at contributions to a worthwhile cause. Okay, so where the income for a year of assessment in respect of a person who has made a donation or contributed to a worthwhile cause is to be obtained, the person may claim a deduction that is equal to the contribution and donation made by that person during that year for a worthwhile cause approved by the commissioner, as shown below. So what are things that the commissioner deems as worthwhile causes? One, if a charitable organization, are you getting it? You make a donation to a charity, okay, which means the definition of a charity under section 97. Okay, so the organization must be in possession of an unexpired written approval issued by the commissioner in accordance with what? Section 97, before we can say that actually it's what? It's an approved charity. Not every charitable organization is approved. You must know that. Approved means he has gone to apply to GRA. GRA has given him approval that this guy is an approved charity, right? If not, if you just donate to any church at all and they are not a religious body which is approved under section 97, they are not going to allow your deduction for the donation. Also, when you support a scheme of scholarship for academic, technical, professional, or any other course of study, it shall be what? An allowable deduction. When you develop any rural or urban area, right? And it should be backed by written attestation by a minister of local government. Are you getting it? A DCE or whoever, or the district assembly, it will be allowed, right? When you support sport promotion or what? Sports development, right? And it should be backed by a written attestation by the Minister of Youth and Sports, confirming the activity as a wet workforce before you can claim. So these ones, it's not just that, oh, if I do a donation, it's allowed. You have to look at it, whether it's a wet work course and it is backed by a written attestation. So there may be other wet work courses that are approved by the Commissioner General, right? So if the activity or event addresses clearly identifiable socio-economic needs at the national, regional, community, or other local levels of the country, it can be quantified in terms of cost. The benefits derived from the activity or event are non-discriminatory in nature. Everybody enjoys from it. You build a KVIP and only 2 people enjoy it. It is not what? A charitable donation. It's not what? A worthwhile cost. Or if the activity or event is not intended, whether knowingly or consequentially, to disrupt social life or cause environmental pollution or degradation. So if you do anything that is of a worthwhile cost, that donation shall be allowed as a deduction. Okay. So we have to look at our best friend, which nowadays, if capital allowance does not come, this one can come, because this one and capital allowance goes together, right? In a period where your expenses are more than your income, including capital allowances, losses and capital allowances are still carried forward, okay? That is where you have a loss. Let's say this is what I'm saying. For instance, let's say my adjusted profit that I had, okay? If my adjusted profit that I had ended up with what? 200,000 loss, okay? And then capital allowance, allowable deduction was 400,000. It means that the loss carried forward is going to be what? 600,000. Do you agree? Which means that to some effect, though the law says capital allowance shall not be deferred under section 14, this is the exception, right? Capital allowance shall be deferred when it forms part of what? A loss-making situation, when it becomes part of an unrelieved loss situation, a loss from business or investment. Okay, so there are rules which, if you are very good at tax planning, you realize that, yeah, of course, capital allowance shall not be deferred like it was under 592. But however, sometimes you can carry forward capital allowances under loss conditions, right? So these are the only scenarios where capital allowance can be sort of carried forward. I hope that is okay. So let's look at this interesting part. You'll be getting it this diet, but the whole thing is now before. If you have business or investment losses, it depended on the industry. If you're in the priority sector industries, you could carry forward these losses for 5 years. And in the non-priority areas, you could carry forward losses for what, 3 years. But now, all the sectors have been unionized, okay? Meaning that now they are one, right? Whether you are in priority or non-priority, from the passage of the Amendment Act, whether you're in priority sector or non-priority sector, the carry forward of loss is just 5 years. Okay, so as simple as that. So losses from business or investment, section 17. The definition of a loss and an unrelieved loss are as stated under section 17(5) of the Act. Now, a business may suffer losses whereby its revenues from sale of goods and services and financial income are insufficient to cover wages and salary costs, material, interest on borrowing money, other allowable expenses, and appropriate depreciation of capital, which is capital allowance, right? Again, losses for tax purposes may arise when forms of income are not subject to tax or when costs are written off more generously for tax purposes compared to economic costs. Losses arising from trade, profession, or vocation constitute business loss, while investment loss arises from losses other than from business and employment. Loss from holding of assets is an example of what investment loss. You are holding some assets, expecting them to go up in value. Then they go down in value. You've lost, right? That is a typical example of what? Investment loss. Now, what are the periods for carrying forward losses? A person is allowed under section 17 of Act 896, are you getting that? As amended, to carry forward a loss from business or investment incurred in a year of assessment to a subsequent year of assessment. In ascertaining income from business or investment for a year of assessment, a person operating in a priority sector is allowed to deduct an unrelieved loss of the person for any of the previous 5 years of assessment. And when we talk about the priority sector, there are some businesses considered in the priority sector. minerals and mining operations, petroleum businesses, energy and power business, manufacturing, farming, agro-processing, tourism, and ICT. Okay, if you find yourself in any of these industries, you tend to be in the priority sector of government, right? That means government prioritizes these businesses because they are cash cows to him. Okay, so they sort of give them a lot of incentives so that people can venture more into those areas. Now, a person operating in a sector other than the priority sector was allowed to deduct an unrelieved loss. Okay, that is a loss that was carried forward from last year or from previous years that have not yet been deducted. So unrelieved, you have not been relieved of that loss yet, right? So you can deduct that unrelieved loss for any of the previous 3 years of assessment in ascertaining the person's income from business or from investment for a year of assessment, okay? That was before the unification. Now at 1094, which is Amendment Act, harmonizes the rules on the carry forward of operating tax losses, providing that all businesses may carry forward operating tax losses from business activities for a period of 5 years. Now, the alignment of these rules implies that the previous classification of entities into priority and other sectors no longer applies. As such, all businesses may carry forward tax losses for 5 years and deduct them in the order in which they came on a first in, first out basis. And today we talked about this, right? That in Ghana, most of our expenses and fungible stuff are always at first in, first out, right? I hope that is okay. So now, don't say priority sector 3 and 5 years, not priority 3 years. However, you can tell the examiner and say that, but a new law has been passed, right? Or the Amendment Act has been passed, which has unified all these rules. Inti asiaba fie. Understood?
Yes, please.
Okay, I think this is not a difficult thing, right? So ABC Mining started operations in 2016. In its first year of operation, declared a loss of 500,000. Okay, so determine the number of years it can carry forward losses. Now, the mining company, if it was before, as at 2016, it will be termed as being in what? The priority sector. And because of that, it can deduct losses incurred. It can deduct losses, not so, incurred in any of the previous 5 years of assessment, right? So the losses can be carried forward from 2017, 18, 19, 20, 21, and 22. That's 20 and 21, sorry. Are we okay? Now, XYZ company was in the business of retailing ladies' dresses. And in the first year,
Bill,
yes, please.
would he carry it from 2017 or 2018?
It was incurred in 2016. So you start from 2017. Do you get it? Is it understood? Is it understood?
So what if it happens on 1st January 2016?
We assess you at the end of the year. So it can never happen that first January. Is your question answered?
The network wasn't clear.
I said we assess you for tax at the end of the year. So it can never happen at the start of the year. William,
Okay.
your question answered.
Yes, sir.
Okay. Now, anytime you get losses, I'll teach you a trick to make loss questions easier for you, right? So let's look at A and B. They started operation on 1st January 2016 and declared losses as follows, right? So 2016, they made a loss. 17, they made a loss. 18, they made a loss. 19, they made a loss. 2020, they made a loss. 21, they made a loss. 22, loss, right? And in 2023, they declared a profit of 800,000, right? So we are now in 2023. So what you are going to do is that what I like to do, practically, this is what we do in the office, right? This is what we do as practitioners. We create loss schedules, practitioners, we always create schedules, send it to GRA, attach it to our return, right? And this is how the schedule looks like. So most of the time, if you get a question, I want you to do this. It makes it easier to understand, right? So we'll get a loss schedule. Usually this loss schedule in the office, you just create it using Excel or create it and then what? You print and attach it to your return. Okay, so we are going to take the year, the loss or the amount of the loss, right? How much is utilized? How much of the loss have you utilized? How much is remaining? Okay. And the year of expiry. When is the loss expiring? Okay. See, I'm giving you all the nitty-gritties that you need for taxation. After the class, you should be a tax expert. Okay, so 2016, we had a loss of how much? 200,000. No, be so. Now we have made a profit of, let's see when it will expire. How many years? Count. 17, 18, 19, 20, 21.
21.
Expire in 2021. Can we utilize it? In 2023, could it be utilized?
No.
It would have expired, right? That's at 2023. Okay, 2017 would have expired in 2022. That means that one too would have expired, right? So 100,000, we couldn't utilize any. It expired from our books. 2018 would have expired in 2023, right? Okay. So if you want to know when to expire, count from the previous 5 years. So 1, 2, 3, 4, 5. You see, that means anything before this has expired. You can see, right? Simple calculation. Makes sense. If you count the previous 5 years, you see that anything before the previous 5 years has expired. Makes sense. So you see anything before 2018 has expired. Okay. Now, let's see. In 2018, how much was the loss?
300.
300,000.
But we made a profit of how much in 2023? 800. Can we deduct the 300 from the 800?
Yes.
Yes.
We can deduct all, right? We can utilize all 300. Meaning how much is remaining? None, right? By to expire 2023. 2019, how much loss did we incur? 50,000.
1,000.
How much profit are we left to deduct?
500.
500. Can we take the 50 out? Yes. And we have how much left? Nothing. It can be carried forward to 2024. Right, but nothing was left. 2020. How much was it?
150.
Can we deduct how much we have left?
450.
Can we deduct all the 150? Yes, we can. We are
Yes.
left with 300. Okay. So expire in 2025. Okay. Go to 2021. How much? 1,000. Deduct all. Yes, we can. So expire in 2026. Then we have 2021. 2022. 500 CDs loss. You can deduct all, right? Now, to expire in 2027. So these are all the losses that we can deduct, right? Loss schedule, that's my working. You see how easy it makes this. When we add all this up, we end up with 501, 500. So these are the total losses that we can deduct, right? So straightforward. If we want to get our 2020, so adjusted profit in what? 2023, right? Already we've worked for that. So what's our profit before tax? It was 800,000, right? No, so then we less allowable deduction. So allowable deduction, what did we have? We had unrelieved loss, right? Unrelieved losses. And we have already worked for it. How much was it? 501, 500, not so, for the previous 5 years. And that gives us what? Our chargeable income. How much is our chargeable income for this, right? 298, 500. How simple is this schedule? Makes it simple, right? So that you don't have to stress in exam. You can do the same for when we're doing financial cost. We did this schedule. Do you remember? There are the losses, financial cost. The treatment had the same carry forward 5 years. Any question?
Yeah, but
Johnson, we
hello.
can hear you. Yes, boss.
What happens when there is an overlap
How?
between the previous 3 and then 5 years for the priority and then the current situation of the unification? Maybe the law started from 2021 up to, let's say, 2023.
Okay, that one you ended there. Then you start the new one. That loss will expire. Any loss that is yet to expire under this law will expire. It wouldn't continue. But the ones that begin from now will continue.
Okay.
So it's like a prospective application, right?
Yeah.
Retrospective. Okay. Is that understood? Any question? Any question? So let's look at different scenarios with losses, because now I know that they like examining different scenarios because students are okay with the normal one. Now, what if you have a business, you run multiple businesses that have different tax rates? How do we do that? So when you make a loss, and if the loss were to be a profit, it would have been taxed at a lower or reduced rate. The loss may only be deducted in calculating income that is taxed at the same reduced rate, a lower rate, or exempt amount. What does this mean? They are always scaring students. Look, if you operate different businesses, right? If this business has a lower tax rate and you make a loss under a business with a higher tax rate, you cannot go and take out the loss from the other business, right? What we are saying is that, let's say I have what? Export sales and local sales. We know export sales are non-traditional export, right? We tax it at 8%. True or false? True or false? True, right? And local sales will be taxed at 25. True or false? And then I make a loss from these local sales. I get it. Or I make a loss from this export sales. I cannot go and charge it against the local sales. It doesn't work like that. Unless maybe both businesses were at 25%, then I can charge this loss against this loss because the net effect is the same. Do you understand? Do you understand? Is it understood? 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 Low tax against low tax, high tax against high tax. That's the rule. Please, is it clear? Or it's not clear to other people? Please, no response. So I don't know what you are saying. I need to know. Do you get what I'm trying to say?
Yes, please.
That's what I wanted to know. So in 2016, I think we have this company's turnover, export sales and local sales, and they had loss from operations, right? During that year, at the end of the day, they had 200,000 loss and 80,000 loss, right? Okay, they are saying, the law is saying that I cannot charge this 200,000 loss, okay, against this 500,000 income. Or maybe if there was a profit, we cannot charge it against the incomes as we see. It won't work. So charge the business that the loss from export against export and the loss from this guy against this guy. Why? Because they have different tax rates. This one will be taxed at 8%. This one will be taxed at 25%, right? So charge each against its corresponding income, right? So when you look at this one, when we come to 2017, right? We had what? Accessible income. So we have profit. And the profit that was declared for this guy was what? 600,000, right? And the profit that was declared for this guy was 100,000. So what happens is that unrelieved loss or carried forward loss that we can deduct from this is how much? This one, we can take the 200,000 from here, right? And this one too, we can take the 80,000 from here. Do you agree? Do you all agree?
Yes.
This becomes a chargeable income. So this one, 400,000. And this one, what? 20,000 also. Then we'll tax this at what? 8%. This one, we'll tax it at what? 25%. That's all. So that becomes a total tax liability for the company, which is 37,000. Okay, so remember, different tax rates, different taxes. But if they were 25, it doesn't matter. You can deduct this loss from here or this from here because it's still the same tax implication. Does that make sense? Now, let's deal with the final part of losses. Then we look at long-term contracts. Then we close. Okay. So, deduction of losses from business and investment. Now, the whole thing is that an unrelieved loss from business may be deducted in calculating income from business. However, an unrelieved loss from investment shall only be deducted in calculating income from investment. What does that mean? It means that if you have a loss from business, you can deduct it from your investment income. If you have a loss from investment, you can also deduct it from investment income. But when you have a loss from investment, you cannot deduct it from business income. Nobody told you to go and make a loss from what? Investment. You get it? Everybody can do investment, but we didn't send you. So if you go and make a loss from investment, why do you want to charge it against your business income? So you can never charge investment loss against business income. It can never work. But the other way can work because the investment, if a gain comes, yay, you can charge your business loss against that. We don't care because still you end up paying profit to us. But investment loss can never be charged against business income. You could have avoided that loss position if you didn't do the investment in the first place. Okay, that's what the law says. So at the end of the day, let's just take a simple illustration. So we have 2 years, 2017, 2018. Now in 2017, there was a business income and an investment loss, right? And we know that investment loss cannot be charged against business income, right? So it means that when we come to 2017, it means that we'll just write our business income, right? We'll just charge our business income, which is 100,000, right? And then it ends there. It ends here. Why does it end here? Because we cannot charge the investment loss against the business income, right? Then the investment loss to be separated. It has nothing to do with the business income. No relationship. It ends there and there, right? That's all. Then when we come to 2018, we actually made an investment income. But we made a business loss. And remember that I told you we can deduct business losses from investment income. So that investment income of 120,000 that we made, we can deduct the losses from the previous year, right? We can deduct the losses from the previous year and the losses from this year. So last year's investment loss was what? Okay, there was an investment loss of how much? 50,000.
50,000.
And there's now a business loss of also how much? 40,000. So the two can be deducted from the 120,000, making 30,000 as our chargeable income. Okay. So this was all about losses from business or investment. Do you have any question for me? Before we look at losses under long-term contracts. Section 24. Any question for me? Any question for me? That means everyone is fine. Okay, so let's look at long-term contracts under Section 24. What is a long-term contract? Now, a long-term contract involves the manufacture, installation, or construction along with related services for someone, right? And a contract is not completed within 12 months from the commencement of work. So it's long-term because it exceeds one accounting year. What are the tax implications of a long-term contract? Now, the income related to long-term contracts is calculated based on the percentage of contract completion during the basis period. So actually, this is from services, right? A contract way is services. It used to be dealt with under IAS 11, okay? A bit of IAS 18 for determination of the stage of completion, and now it is covered under IFRS 15, but tax still uses this one to work and the old IAS 18 revenue to work, right? Tax has not yet adopted, unless maybe there's an amendment that is going to implement this IFRS 15 revenue from contract with customers. But however, when it comes to revenue recognition, we still use the rules under both IAS 18 and IFRS 15 to determine revenue for tax purposes, right? That is from your ordinary course of business. Okay, so we are saying that income related to long-term contracts is calculated based on the stage of completion. And stage of completion, we have a lot of methods, right? We have two main methods that we use to get a stage of completion of a contract, right? The first is the work certified approach. Work certified is simply the work you've done till date, right? And what you do is that you just take your work certified over the contract. So this is based on a percentage of revenue, right? So you are saying that to get your stage of completion, you are just taking what? The work certified, which is the work you've done till date, over the total contract price. Over the total contract price times 100, right? And that tells us what work you've done till date. What's the percentage completion of the contract? Or the cost approach. Okay, we can use the cost approach, which is what the income tax recognizes, the percentage of total cost. So this is where you are taking what costs you have also incurred to date. So you are taking your costs, your contract cost to date, all over your total costs, okay, of the contract times 100, right? And this is the accepted one. Okay, but however, it depends on the nature of the contract in accounting. But here, this is the only one the tax law allows, because here can be subject to what? Manipulation, right? So they prefer the cost one, because cost, if you incur their invoices to tell us, but this one, it is estimates based on the next 3, 4, 5 years, right? So what shows that this contract price is even at market value, right? That's why tax law does not choose this one. Tax law likes this one because cost, that one, we know how much you will incur and there are invoices to support it. But this one, you can say that our total contract price for 5 years is this. How do we know this is true, right? So tax does not allow this one. It allows this one. Are we okay? So the percentage of completion is determined by comparing the total expenses allocated to the contract incurred before the end of a basis period with estimated contract expenses at the contract commencement. Okay, and that is what we've rated. Cost to date over total cost times 100. Now, how do we recognize the contract income and expenses? Now, when the outcome of a long-term contract can be reliably estimated, contract income and expenses are recognized by reference to the stage of completion at the end of the year of income. And expected losses can be recognized as expenses immediately. So we are saying that if the contract will be a loss-making contract, then the expense that you are going to incur under the contract as the loss, immediately you can allow it as a deduction, right? It is immediately allowable. If after doing that estimation, you realize that it's a loss-making contract. Even under IAS or the International Accounting Standards, this is still allowed. It's the same rules under our Section 24. Now, Section 24 to provide specific rules for accounting for revenue and expenses under long-term contracts. Now, the percentage of completion of the contract during the year of income is used to calculate the income and expenses. An expenditure allocated to the contract and incurred during the year is compared with the estimated total contract expenditure at the commencement of the contract. So, how do you measure the completion? Progress payments and advances received are not considered in determining income for tax purposes. So if they made any payment under the contract, it's a capital issue or it's a balance issue, accounting balance issue, or balance sheet item, has nothing to do with profit. And the percentage of completion is assumed to equal the percentage of total cost during the year, okay? Contract revenue is matched with contract cost during incurred in reaching the stage of completion. So when you are determining the stage of completion, I told you there are several methods, but we prefer what? The cost, the percentage of cost one. So how then do we measure contract cost, as I was saying? Let me give you a typical example, right? So there's a total contract price here. So let's say we have a contract, right? And it has a total contract price, okay, being 120 million, okay? It's 120,000. Let's say it's million, but we are working in thousands, okay? 120 million. And then the costs, okay? We have cost to date. A car in the expenditure we have incurred to today, right? Cost to date. We have incurred a total cost of what, 65,000, and cost to complete, okay? We need a total cost to complete this contract with, let's say 25,000, right? So this is the total cost to complete, okay? And then they are telling us that we should what? This contract is incurred over, let's say this contract is over 5 years. Okay, this contract is over 5 years. Okay, it's a 5-year contract. And then they are asking us to recognize the expenses and income for this particular year, or the year in which we are standing, the first year or something like that. Now, what you are going to do is that, first of all, the first step is to estimate the stage of completion, right? Percentage of completion. And what method did I say we use? What method did the tax law allow? Which method does the tax law allow for determining your stage of completion? What method does the tax law allow for determining your stage of completion?
The cost method.
And how do we get it? How do we get it?
Percentage
Cost
cost
to date
Have incurred to date
over
or the
expense.
total cost.
all over total cost or expenses times 100, right? Okay. So
Yeah.
when we go to our example, what's the total cost? We know that we must incur a total cost of what? 90,000, right? That's our cost to date plus cost to complete. That gives us our total cost, right? Okay. So we are saying as of now, we have spent 65,000 out of a total cost of 90,000 we are supposed to spend, right? Times 100. Are we okay? Are we all okay? And what would that be? How much would that be? What's the percentage complete? So it means this contract is 72.22% complete, right? Do you all agree? Do you all agree?
Yes, please.
Okay. But in the 5 years time, what's our estimated profit over the 5 years? We know that the total price of the contract was what? 1.2 million, right? No, it was 120 million. And the total cost of the contract was what? Total cost of the contract was 90,000, right? It means that over the 5-year period, the total estimated profit from this contract will be how much? 30,000 also. Okay. But now we are only 72% complete. So it means that we must recognize only 72% of the profit, right? So let's go and recognize our profits and way in the year of assessment. So in the year of assessment, okay, if this contract was a 3-year contract, okay, if this contract was a 3-year contract, it means that every year a different cost will be incurred and a different profit. So if we recognize our revenue, we can only what in our for tax purposes, it means that we can only recognize what, since we are in 72.2%, we can only recognize 72.22% of our revenue. Okay. And we can recognize what, only 72.22% of our costs, right? Which was also what, 90,000. So how much would we have recognized for tax purposes for this year of assessment we are in? Do you understand? Thus, we can recognize revenue of 86,664. But this one is for the whole period. So if there was any previous revenue recognized, we have to take any previous one from it so that we get only the one for this year. So the same way too, we can do the same for our 90,000. And then we have what, 64,998, right? And that becomes what? The profits from the contract, right? The contract profits, that has to be what? Recognized. So 86,664 minus our 64,998. And that's 21,666. And you can cross-check by just multiplying this by 72.22%. The estimated profit you estimated at the start of the contract, right? Times. Yes. So this is how you recognize contract cost. Understood? Understood. Understood. So just like how we saw the what? The percentage of completion. You take your cost incurred to date over your total cost, right? So you see, you add your total cost and take out what? This over that, you get 28.5. Well, what is the tax implication? Revenue and expenses under the contract will be allocated based on the percentage of completion for tax purposes. We just saw that, right? But there's one particular rule I want to talk about, which is how we treat unrelieved losses under long-term contracts, okay? Now, section 24.4 allows for the treatment of unrelieved loss on completion of a long-term contract, okay? So what the tax law does is that it needs proof, okay? So if a person has an unrelieved loss for a year of income attributable to the long-term contract, the commissioner may allow you to carry back the loss to the previous year income or treat as an unrelieved loss for that year. So you have an option. So if you are doing your estimate, right? So let's say you are doing year 1 estimate, year 2 estimate, year 3 estimate, year 4, okay? And you realize that this year, profit 100, profit 200, profit 300, right? And loss 200. The law says, okay, if there's a profit for which you made the loss, you can set this off against the profit or carry it back and deduct this from the 300. Okay, because you are estimating. Now, if you go to year 3, you would have had what? A profit of what? 300. Then you have a carried back loss from year 4 of what? 200 to be deducted from here, right? Which means year 4 will now be empty when it actually happens. Because for long-term contracts, you estimate, right? So based on the estimate, it can allow you, if you know that year 4, you have a carry forward loss, you can treat it as a loss, or you can carry it back and deduct from the previous year because you haven't gotten there yet, right? That's what the law allows you to do. Okay, so you can carry back the loss to a previous year income or treat as an unrelieved loss for that particular year. The commissioner has the discretion to allow the unrelieved loss for the year of income to be carried back to a previous year of income. This provides flexibility in managing losses incurred during the period of completion of long-term contracts. Now, the law imposes a limit on the amount that can be carried forward as an unrelieved loss for the year of income, right? The loss to be carried forward is restricted to the amount of deduction claimed in that year. So assuming the loss that we saw in year 4 was 600, we can only carry back how long? How much of the loss can we carry back? How much of the loss can we carry back? How much of the loss can we carry back? Nobody's talking, no. If we made a loss of 600,000 in year 4, and we had a profit of 300, estimated profit of 300 in year 3, how much of the loss can we carry back? That's my question.
300.
Only 300. That's the limit. You cannot deduct more than, right? That is it. You can only carry back the 300. And that 300 left can be set off as well a loss for that year carried forward to the next year. Okay, so that's carry back of losses. This one is different from carry forward because you estimate, you know that this year you may make a loss, so you can set it off the previous year. The commissioner allows that, right? That's what I was explaining. Okay, so let's take a simple illustration. The total contract price for the construction of a cinema complex at Accra is 500 million, and the estimated costs, total costs are 450 million. The contract is estimated to last for 3 years, okay? So the percentage of completion of the contract is 25% at the end of year 1, 75 at the end of year 2, and 100% at the end of year 3. They've even told us, right? So what you can do is that you can even estimate the total cost, right? Straightforward. So the total revenue is the contract price, which is still the same for each year. Now the contract cost incurred to date, if they tell you it's 25% complete, that means 25% of the costs have been incurred to date, right? So I just take 25% of this, 25% of the cost, the total cost, right? So 25% of this, 75% of that, and what 100% of that will tell me the total cost that I've incurred, right? Then estimated cost to complete. As at year 1, we spent 112. It means we have 337,500 to complete the contract. And then year 2, we spend this, so we have this to complete. Year 3, we would have incurred everything. So the total estimated cost will be 450. Now, this is the percentage of completion, which has already been given us. Otherwise, you can calculate it yourself, right? So for year 1, to get your revenue, you would have just taken your contract price, which is the 500,000 at 25%, making 125 million. You would have taken your expenses, 450 million at 25. You have this. Then you have estimated profit of 12.5, right? But the whole thing is that if I go to year 2, okay, remember that I'm taking 75%, which still includes that 25. It means that when I go to year 2 and I get my total revenue, I must deduct the previous year's income from it because it is still within that 75. You get it? And also take this year's cost also from it. When I get to year 3 too, I will deduct last year's revenue and cost also from it. That's how we do long-term contract over some number of years, so that you can only get the one that belongs to that particular year. Okay, so nobody is going to ask you this in exam anyway. If it will come, it will be very simple like the one we saw first. So don't stress yourself, right? Okay. Now, the last thing we talk about is additional deduction for fresh graduates. Okay, so if you employ a fresh graduate, there are some additional deductions that you get under the Ghanaian tax law. Okay, so who then is a fresh graduate? A fresh graduate is a person who has graduated from a tertiary institution for the first time, whether or not the person was previously employed. Okay, so the employers who engage fresh graduates are entitled to an additional allowable deduction. And that additional allowable deduction is to enable them increase the tax loss or reduce the chargeable income. And how does the mechanism work? So we look at the percentage of fresh graduates in the workforce against how much additional deduction you are getting. So if you employ up to 1% of your workforce as fresh graduates, you get 10% of the fresh graduate wages and salaries as a deduction. If you employ above 1%, but not more than 5%, 30% of their wages and salaries is an additional deduction. And if the fresh graduates are above 5%, then 50% of the wages and salaries of the fresh graduates are treated as allowable deductions. So let's see, the Maxis, which we've seen before, right? That company. He has the following information available for a year of assessment. So he had gross profit, less wages and salaries, 400, depreciation, 300, admin expenses, 50,000. And there was net profit before tax. Now, additional information. During the year, the Maxis employed 5 new fresh graduates. The total workforce of the company were 300 employees. And the total 10% of the wages and salaries were paid to the fresh graduates. Compute the tax payable for the Maxis. So let's see the percentage of the workforce. What percentage of the workforce was fresh graduates? Can we find that? So let's see percentage of the workforce. How many employees did we have? So we took five new graduates over how many employees did we have? How many employees did we have?
300.
300 employees. So we employed 5 out of 300. And that is how much? How many? What percentage is that?
1.6.
1.6%. Okay.
Yes.
Which means that this is what?
Above 1.
Above 1, right?
Yeah.
Above 1, but between 1 and 5, right?
Yes.
Above 1, but less than what? 5%. Meaning what's the
Up to 5%.
yes.
30%.
The deduction is going to be what?
30.
30%. The wages and salaries, right? For the fresh graduates. Okay. So in that case, first of all, what is the wages paid to the fresh graduates? You said 10% of the total wages, right? Which was 400,000 was paid to them. That means the fresh graduates, we paid them 40,000 also. Okay, so 40,000. So what's the deduction that can be granted to them? 30% of the, and that's 12,000 also. Additional deduction. 12,000 additional deduction can be given to them. So let's go and compute our profits. So the Maxus Limited computation of chargeable income for the year of assessment. So what's the profit per the account? 150,000, right? So we add back, what and what do we add back? Only depreciation, right?
Depreciation.
Depreciation, how much? 300,000. That gives us 450,000. That gives us our adjusted what? Profit, not Then we now less other allowable deductions, right? There was no capital allowance, but there was fresh graduate what? Deduction, right? How much was it?
Wow.
12,000.
12,000.
Fresh graduate deduction. So that gives us 438,000 also. So chargeable income. Boom. So that brings us to the end of all the deductions under the income tax act. There's another deduction, but I won't treat it here. Okay, that's the only deduction that I won't treat here. It only applies to individuals. Okay, so when we get to taxation of individuals next week, I will talk about it before we start. And that has to do with mortgage interest deduction, right? That's the last deduction that we haven't looked at, the sixth schedule as amended. Okay, and it's very interesting. Okay, it's the only deduction that you can get even against an individual's employment income together with the donations to a worthwhile cause. So these are the only deductions. So for now, I assume you know every deduction from interest to repairs to bad debts to website costs to legal fees, financial costs, foreign currency losses, losses under long-term investment, contract costs, everything. I mean, there's nothing on the surface of the earth that is a deduction that you don't know. So I expect you that when you get any question that has to do with add back, you can add back without stress. True or false? True or false? So God willing, next week is a question bazaar, right? We are solving questions that have to do with add back deductions. So we'll be taking add backs regarding individuals. Okay, so most of the questions we'll solve will relate to tax liabilities, generating corporate tax liabilities, personal ones for individuals and others for companies. And the kind of companies we are going to be dealing with is a combination of everything we have learned. We'll deal with manufacturing, mostly manufacturing. That's where the questions focus, very heavy questions. We'll deal with manufacturing and then merchandise, right? These are the kind of questions that kill students a lot, right? Very heavy laden questions. Always has a bunch of capital allowance computations, very heavy. So once you are comfortable with these kind of questions, then I know that, yeah, my people are okay. Okay, so that's tax for you. And that brings us to the end of our session. May the Lord be with you. And see you when you see me.
Also with you.
Though today we didn't learn anything.
Thank you.
Today we didn't learn anything. It has pained me, pa. Oscar,
Oh, Prof, we've learned so much. Oh.
really?
Yes.
Oh, me today, I didn't see that we learned anything. Oh. Oscar, did we learn today? Oscar, did we learn today?
A lot.
A lot.
Yes,
We didn't
please.
learn anything. Oh. So let me try and convert the video and share with you. Okay, so
All right, sir.
please go through again the deductions because we'll be solving. Let me just show you a sample of the question you'll be solving. Then you see that next week it no be joke. Okay, just going to share a sample of the questions for you, and then you'll be like, oh, okay, so these are the kind of questions that I will be dealing with. Yeah, questions are very loaded. Let me just show you one of them. Oh, what is this thing? Once. Oh, please hold on. I'm trying to see where I put my questions. Things are plenty. Um, let me show you. Okay, so look at this question. Take you to the Lord in prayer. See, Aquafresh, right? A company based in Osu and produces clean water through a desalination process and as a byproduct producing salt for sale in Ghana. Okay, can you see? Or it's you can see. Desalination is a process. Can you all see my screen?
Yes.
It's a process which extracts salts and minerals from seawater so that the water becomes fit for human consumption. This desalination process has been declared by the GRA as a manufacturing process. During 2022, Aquafresh recorded the following transactions. Sale of desalinated water made to private domestic homes totaled 120 million, while salt totaled 15 million. Operation cost in relation to Aquafresh Limited manufacturing and processing plant amounted to 50 million. Maintains a stock or inventory of spare components or parts for its processing manufacturing. This inventory includes a special inventory called membranes, which are used in the desalination process. The company had 10 membranes in inventory at a cost of 250 each. You see, everything we learned, they are putting it together at the start of the year. During the year, it purchased additional 2 membranes at a cost of 300. What are they bringing on board? What deduction are they talking about here? Look at it carefully. What are they talking about? It had 10 membranes in industry in inventory at the start of the year. Then they purchased additional membranes. Due to wear and tear, 6 membranes from the manufacturing plant needed to be replaced during the year. The 6 store membranes were accordingly removed and destroyed during the year. So what are they? What expense are we seeing here? From what you learned today, see how tax is becoming. You have to apply everything you learned. That's why you are no longer doing surface tax. What are they talking about here? Is it not trading stock?
Yes, trading stock.
A holding tank for the salt broke and flooded the manufacturing plant. The cost of cleaning the plant was 3 million. The holding tank had to be replaced, and the replacement holding tank cost Aquafresh 10 million, which was funded mainly by insurance proceeds of 7 million. The original holding tank had cost 6 million and had a tax written down value at 1st January 22, the start of its last year of its tax useful life, 1 million. These taxes are not considered part of the process of manufacture as they merely hold the salt. The water produced is pumped into 2 temporary holding tanks. These tanks had been purchased by Aquafresh Limited on 1st June 2022. The same date it acquired some vacant lands in Jamestown, in Accra. The land cost 9 million and the 2 tanks cost 5 million each. These tanks are not considered part of the process of manufacture as they merely hold the desalinated water. In 2022, Aquafresh Limited installed sea-based wind and energy turbines along the length of its water pipelines. This was done to offset the high energy requirements for the desalination process. These wind and energy turbines cost a total of 6 million. The wind and energy turbines have been certified by the GRA as manufacturing asset. So pool what? Manufacturing asset, what pool?
2.
Pool 2, thank you. Specific bad debt rating of amount to 4 million. Allowed or disallowed? We have to check, right?
But you have to check.
Specific. A further 10 million is listed by Aquafresh as general provision. Allowed or disallowed? Disallowed. In its accounting provision for the year ended 31st December 2022, the list for general provision for doubtful debt was 9 million at the start of the tax year. Wages and salaries amounted to 30,500, and the written down value of the assets were this, and cost of buildings at January 2022 was 5 million. Question if you will more. Looks confusing, eh? Tell me the truth. Are they lying? Is it not confusing? Doesn't the question look confusing? Why are people quiet? It's confusing, of course.
Yes.
Yes, I know it's confusing. Now, these are the type of questions that you are looking for, right? The one that will give you a long table like this. Are they like this kind of questions where they'll give you a long table like this and then they'll put notes under and look at the notes. How many notes? Plenty. Plenty. So let's just go through this quickly. Promotion and advertising. Expenditure is made up of managing director's wedding reception. Allow or disallow?
Disallow.
Refreshment during opening of new shop. People are quiet. Refreshment when I open my new shop.
Disallow.
Sample product to invite guests during opening of the shop.
Allow.
But why the refreshment during opening of new shop? You said disallow. But sample product to invite guests during the opening, we allow that one.
I don't know.
The sample product is what the company deals in.
Okay. Okay. You need to provide a better way. Interest and bank payment. This expenditure is made up of interest on loan used to purchase stock for the business. Allow or disallow?
Allow.
Overdraft interest on the business account.
Allow.
Legal expenses. This expenditure is made up of court fine resulting from traffic accident.
Disallow.
Disallow. Defense of company driver for careless driving.
Disallow.
Litigation on business plot of land. 90% chance of success.
Allow.
Do you know why we allow? I said when you incur legal costs for defending title or protection of your asset, it should be allowed. Do you remember? Okay. Bad debts. The expenditure is made up of 1, debt collection, the cost of pursuing bad debts, 455. Allow or disallow?
Allow.
Decrease in general bad debt provision. It must be reversed, right? Increase in specific bad debt provision must still be reversed. is an estimate. Increase or decrease in bad debt is an accounting estimate. Motor expenses, lease of a delivery van, van running expenses. See? Sundry expenses, we have trade subscriptions, support to elect local assembly member. It's a donation. Is it a worthwhile cost? No. Provision for replacement of windows in the office. Repairs and improvement, right? But this one is a
Yes.
small amount.
Allow.
We can allow it. Gift to customers during Christmas.
It's allowed.
Allow or disallow?
Allow.
You have to state your assumption. Customers claim on these defective goods. Customers sued you for defective goods. They want their money, like warranty costs. Provision for staff redundancy is a provision, right? Disallow. Cost of investigating cash fraud. Investigation to acquire a new company. You see how the expenses come nowadays? It can confuse you. You sit on this question and then all your time will be gone because the things do not make sense, right? So if you see me doing plenty expenses, it's because of some of these questions, right? Total confusion. So you get the journey ahead, right? I'm just showing you so that you prepare well, right? May the Lord be with you. So you start practicing. What solutions? Add some to your toolkit, take some out. That's how we learn, right? And gradually, I believe we'll all be fine. Amen. Have a good night, and then we'll keep in touch. Please, those who are owing, make sure you settle your outstandings, right? We dey beg. Okay, good night.
Okay, bye.
Okay, bye.